Crypto and stocks both have the potential to grow your wealth, but they come with their own risks. While stock markets are heavily regulated, cryptocurrencies operate on unregulated exchanges. Stocks convey ownership in a company, and their value fluctuates on market trends and business performance. Individual stocks are less volatile than crypto, but they're still highly speculative. This makes them best for investors who can leave their investments alone for long periods of time. Risk. Stocks and crypto are both investments that offer the potential for substantial gains. However, each has unique risks and rewards. Understanding these differences can help you make the right decision for your investment goals. Regardless of which type of investment you choose, it is important to practice sound money management techniques and do your own research to protect yourself from financial loss. The key difference between stocks and crypto is their level of volatility. Cryptocurrencies have high volatility, which can lead to rapid price changes. This makes them more risky than stocks, which are regulated and trade through established exchanges. Additionally, cryptocurrencies are not backed by physical assets and can be subject to hacks and so-called rug pulls. These incidents can cause a cryptocurrency to lose value in a short period of time. Another difference between stocks and crypto is their sensitivity to interest rates. As rates rise, investors may shift money from stocks to bonds, causing a sell-off and potentially leading to a market downturn. Conversely, if interest rates decrease, stock prices may rise. While the stock market has a long history of stable returns, it is not immune to volatile markets. The recent market turmoil has led to a decline in the value of many stocks, which can lead to losses for some investors. Fortunately, there are ways to mitigate the risks of volatile investing, including diversifying your portfolio and sticking with a long-term strategy. Cryptocurrencies, on the other hand, are a relatively new phenomenon that has experienced considerable volatility in its short history. This has attracted a number of traders and investors, but the industry is still maturing. While cryptos are a viable investment option, they should be limited to a small percentage of your overall portfolio. Stocks are a comparatively safe investment because they're backed by SEC regulations and centuries of market research. But they are also prone to price crashes and invalid shares. In contrast, cryptocurrencies are backed by blockchain technology and don't depend on any centralized authority to govern them. In addition, they are more resistant to regulatory pressures and don't have the same sensitivity to interest rates as bond funds. Returns. Cryptocurrency has gained a reputation for wildly fluctuating value, but it can also yield large returns. As with any investment, it's important to carefully weigh the risks and rewards of investing in these assets. But how do you decide whether crypto is right for your portfolio? The answer depends on your risk tolerance, financial goals, and time horizon. For those with short-term investment horizons, the return potential of crypto is likely to outweigh the volatility. For example, some investors may consider using cryptocurrency to fund an education account for their children. With a longer investment horizon, these assets can provide attractive, consistent returns. However, you should always remember that volatile investments carry more risk than stocks and may lose value quickly. In addition, the returns on stocks can be unpredictable. A company's share price can rise or fall dramatically, depending on the market conditions and the company's performance. In contrast, the value of cryptocurrencies is tied to an international network of computers that constantly updates. This makes it difficult to manipulate the value of a cryptocurrency. Stocks have many advantages over cryptocurrencies, including the ability to diversify a portfolio. In contrast to cryptocurrencies, which are volatile and unregulated, stocks represent tried and true investments tied to real-world companies. They are also more stable than cryptocurrencies, but they're not immune to the effects of a global recession or company-specific issues. Another benefit of stocks is their transparency. Unlike cryptocurrencies, which can be traded on an exchange, shares of publicly traded companies are regulated by the Securities and Exchange Commission and must disclose all information that could affect their share prices. This gives investors and their financial advisors a lot of information to make informed decisions about their investments. Investors seeking higher return potential should consider a mix of both stock and crypto investments. Cryptocurrencies have the potential to yield explosive returns, but they're a more volatile investment than stocks. To minimize the risk of losing money, investors should only invest in crypto if they can afford to do so without affecting their everyday budgets or retirement savings. Regulation. Stocks are traded on a regulated market and represent ownership in established companies with tangible assets and revenues, while cryptocurrencies are speculative investments that don't offer any of this. They also have a much shorter history than stocks, making them more volatile and susceptible to irrational selling. Investing in cryptocurrencies can provide exposure to innovation and potentially high returns, but it's important to understand the risks before investing. Cryptocurrencies are essentially digital tokens that can be used on a public ledger called the blockchain to buy and sell real products and services. However, unlike shares of a company, which represent equity in a business, cryptos don't offer any rights to dividends or voting power. This makes them more of a commodity than an investment, and they're also susceptible to hacking and so-called rug pulls, in which hackers steal money from new token sales. On the other hand, stocks are highly diversified and have a long track record. They can be invested in companies in any industry or country, which helps diversify your portfolio and reduce your risk of losing everything. Stocks can also be a good source of income, since many pay out dividends to shareholders. Nevertheless, they can still be risky investments and are better suited for long-term investors who can afford to ride out volatility. The choice between crypto and stocks depends on your investment horizon, comfort level with risk, and your overall financial goals. The decision between the two ultimately comes down to how you want to weigh growth potential against stability and regulation. Some investors choose to allocate their capital across both, leveraging the benefits of each while limiting their exposure to volatile markets. The main thing to remember when choosing a cryptocurrency is that it's a volatile asset, so you'll need a lot of patience to weather its ups and downs. In the long run, cryptocurrencies can be a great way to diversify your portfolio and protect against inflation, but they're best suited for those with a longer investment horizon. Short-term traders can often find more opportunities in other kinds of assets, such as bonds or funds. Time horizon. Stocks, also known as equities, are a cornerstone of traditional investing. They represent ownership shares in a company and are closely tied to the fortunes of the economy. But they come with their own set of complexities and risks. For one, stocks are heavily regulated and are subject to high taxes. In addition, they often offer only modest dividends. However, despite these drawbacks, stocks have the potential to grow wealth over time. Cryptocurrency, on the other hand, represents a more recent innovation. It takes the form of digital tokens that are used to buy and sell products and services. They are encrypted for security and leverage blockchain technology to validate transactions. Some cryptocurrencies, such as Bitcoin, are limited in supply, while others, like Ethereum, do not have an established limit. While many investors are intrigued by the potential of cryptocurrencies, they should consider their financial goals and risk tolerance before investing in them. It is generally recommended that volatile investments be limited to a small percentage of a portfolio. This way, a loss in the asset won't jeopardize the entire portfolio. In addition, it is important to understand the risks associated with these investments, which can be largely mitigated by choosing an exchange with good security practices and a low volume of trades. Another key difference between crypto and stocks is that the stock market is highly regulated and operates through established exchanges. This ensures that investors are protected by a wide range of rules and that companies regularly disclose accurate financial information. The cryptocurrency market, on the other hand, is largely unregulated and can be more volatile than stocks. Moreover, stocks are only available during normal business hours, meaning that trading cannot take place after a certain time of day. By contrast, crypto markets are open 24/7 and can be traded with a tap of a button. This makes them easier to access and trade, but it can lead to price volatility. While the crypto market has a lot in common with stocks, it is still a very new investment opportunity that is likely to undergo significant changes over the next few years. As the industry evolves, more and more professional investors will seek transparency, liquidity, and regulation in crypto assets. This could be a positive development, as it will help the market gain legitimacy and attract more investment capital.